Good afternoon, everybody. This is David Casper. I'm with the SALT Group in Fargo, North Dakota, and joining us later will be Stacy out of our Denver office. It's one of the first things that I wanted to get out of the way, if I can. There we go. So our overview today will be, we're going to talk a little bit about registering a business. Spend a fair amount of time on the Wayfair case and some of the new laws that are coming out. Stacy will go through developments in our income tax arena. Okay. And there was a pretty notable court case a 3 weeks ago. The old Quill decision has been overturned. States are changing rules. There's lots of talk in the media about this, but there seems to be a bit of a misconception. These new rules are in addition to existing rules already. If you have physical presence in a state, be it through property that you own or lease, employees on the ground, making sales, making repairs, any of those sort of things, you still possibly have the Nexus connection and a need to register for and collect tax in other states. But anytime in a state, especially in North Dakota, if you have an agent, someone you've hired to do something for you, or an employee in the state, that comes down to selling taxable items at a trade show. If you or someone you've hired come into the state to install, assemble, service, or repair something, or the more common delivering goods to North Dakota using your own truck, you already have the Nexus connection and need to consider whether or not you should be registering. Those laws have been in effect for many years, and they still are. Just want to review that. Seems that the economic Nexus rules have been overshadowing these a bit lately. The Quill decision came out, and it's not the Quill, the Wayfair decision overturning Quill came out, and the very next morning at 7 a.m., the state of North Dakota had already changed its website and posted this screen. They had already put out there what their requirements are for remote sellers. Now, not all states have remote seller rules. There's about 15, 16 of them that do. Not all of them have posted their guidance yet. But for now, we're just going to concentrate on North Dakota as they are our topic for the day. Note I have put the website link at the top if you wanted to write it down, get there later. But who is a remote seller? Anyone who makes sales in North Dakota by using the internet, postal mailing, by phone. I actually purchased some pieces by phone the other day instead of using the website. I called the man and made the transaction. By fax, possibly, possibly not. But the internet sales also include things you're selling through Etsy, eBay, Amazon, or any other number of formats. When you click that link on the North Dakota website, the more information, this is what the state has posted. If you do not meet the small seller exception, which is you have less than $100,000 in taxable sales shipped to North Dakota, or less than 200 transactions, that would be invoices, of taxable sales ship to North Dakota. So if you're not over those thresholds of $100,000 in taxable sales or 200 taxable transactions, if you haven't exceeded that threshold and you're not already registered, like because you had physical presence, at this point, you don't need to do any registration. But if you have made into the state 100,000 in taxable sales or 200 taxable transactions, you are now required by North Dakota state law to register and begin collecting our sales tax. This includes the state and all the local taxes on or before October 21, 2018, or 60 days after you cross that small seller threshold. For example, if you were under that threshold last year and you're under it this year, say through about July, and then July you cross that threshold, they're giving you another 60 days to get registered and move forward. Another part of this web page is they offer you some FAQs. At the top highlighted line it says register to collect sales tax in multiple states through the streamlined sales tax registration. I'm going to throw out a big warning here. If you use that link, you are registering through the streamlined sales tax group, which is about 20 states that have gotten together. And when you register there, you register for all 24 states, not just the ones that you wanted to, and maybe not necessarily all the ones with remote seller reporting. And you are expected to begin remitting those returns immediately. I much prefer the link below it that is apply for a North Dakota sales and use tax permit. You can do this online, it's pretty straightforward, and you are only applying for a North Dakota permit. That would be the link I would choose to use. In the FAQ section, there's a couple of notable ones that I highlighted. The first one, what is a remote seller? Just in case you're curious, am I doing something that's considered being a remote seller? Likely if you're shipping any type of taxable product into North Dakota or bringing it in, you will be considered a remote seller. They also have a section down there that discusses through a marketplace, which is referring to the Amazons, Etsy's, and eBay's. Looks like we have our first polling question. Wayfair remote seller requirements are being adopted by more and more states. The consequences for not complying can be significant. How aware are you of the states? Are you very aware, heard about it, or this is completely new? And we'll give it a moment or two. Looks like most of us are aware but have not taken action. Okay. The next question becomes, if I'm a remote seller, what sort of items are going to be taxable in North Dakota? Pretty much anything that you can hold in your hands is going to be considered taxable here. Clothing, most tangible property, most non-farm machinery and equipment. If there's an invoice and it has a taxable item on it, any associated freight delivery charges on that invoice will also be taxable. Downloaded software is taxable here, as are some maintenance contracts. Prepared foods or meals are typically taxable. And tickets to entertainment such as movie tickets and concerts are also taxable. Most tangible items are taxable here. Very, very few services are subject to tax. So sales tax is calculated based upon where the purchaser receives the item. North Dakota is what they refer to as a destination-based state. If you pick up an item at the store, you pay the taxes in effect at that store where you set your hands on the item. If you order something over the phone or the internet and it is shipped to you in Jamestown, you have received the item and taken possession in Jamestown, it should be taxed using the tax in effect at the destination of Jamestown. If the item is shipped from North Dakota to another destination, say Minnesota, North Dakota tax does not apply. North Dakota is only taxing items where the purchaser is taking possession in the state. Throughout the year, we do get quite a few questions regarding the dreaded sales tax audit. Audits go through a pretty standard pattern. You'll receive a notice. They want to come and audit. There will be an initial meeting to discuss what they're looking for, what the expectations are. You'll provide some initial documents. The auditor will then request a bunch of information from you, and they may process that information using statistical sampling. They may just pick certain months and use that to forecast over the other periods. During this time, you use your resources to prove whether or not certain items were taxed or should be taxable. After you've done what you feel you can do, typically a summary of audit findings comes out. It's a listing of all the items that the auditor believes were taxed incorrectly. Usually it's accompanied by a total dollars and a breakout of the penalty and interest. One thing to note that in North Dakota, interest on a sales tax audit is calculated at 1% per month, or about a 12% annual interest rate. In audits that stretch back a ways, that interest can be just about as much as the actual tax due. But something to think about. After you have received this notice or at any point during the audit, always have someone else review the auditor's findings. Think of this as asking for like a second opinion from a different doctor. There's a lot of reasons these audit findings may not be representative of what's actually happened. Perhaps the auditor doesn't understand your business. Maybe you're in heating and air conditioning. The invoices they were looking at were complete Greek to them, and they just looked to see whether or not they had tax. Auditors may not have documentation. Sometimes auditors interpret the tax rules differently than other people do. because the auditor is there and they're people working, doing their job, they are there to review your records as efficiently as possible and see if you owe any money or if the state owes you any money. But typically, auditors are not there to educate you about tax rules, especially if they could benefit you. The reason I say have somebody else look at them. I have yet to look at an audit findings from pretty much any state and not make a reduction in it by methods as simple as getting invoice copies, getting a better understanding of the records, explaining it differently to the auditor. So please, if you get an audit findings and it's got a substantial dollar amount on it, reach out to somebody and ask them to take a look at it. There's no point paying for something that you really shouldn't have to. And typically you can make a reduction in the audit notice. One thing we do see is people sell their business or they just close up shop and they forget to deal with the sales tax license. They were so concerned with selling the assets, getting the deal done. They did not close out their sales tax permit. And then 60 days later, the notices from the state start. Where is this return? Where is that return? North Dakota closing out a sales and use tax license is pretty straightforward. When you're supposed to complete your final sales tax return, and they're all pretty much online now, within 15 days of closing the doors or the sale of the business. Usually, if you've done a North Dakota sales tax return, you see a box up near the top that says, will this be your final return? Don't ever mark that unless it's actually your final return. If you've sold the business, they will ask you to provide the new owner's information. That's all there is to closing out that sales tax permit. So if you sell your business, close it, whatever changes, please do not forget to close out that permit. And before I turn it over to Stacy, I just wanted to let everybody know that we do have a webinar coming up on noon, August 2nd, where we will be reviewing the initial 10 or 12 states that have issued guidance on remote sellers and tax collection. Stacy?
All right. Thank you, David. Okay. So, as David mentioned, I'm going to launch into a few income tax topics for North Dakota. You know, similar, if you've been in our other state presentations, kind of similar flow here. But in the wake of Wayfair, we've got some things maybe that we might need to think about from an income tax side, particularly as it relates to NEXUS. And normally and generally, income tax NEXUS standards are completely different from sales tax NEXUS standards. However, now with Wayfair and the economic rules, they're starting to look a little bit alike. However, I did want to just kind of highlight some nuances, and we can, we'll talk about North Dakota specifically here, but just wanted to have people take away a few things to think about, particularly, like I said, in light of Wayfair and how this might impact income tax NEXUS. But generally speaking, for income tax NEXUS in North Dakota, from a policy standpoint, the corporate income tax applies to corporations that are, quote unquote, engaged in business in the state or have North Dakota sources of income. Well, interestingly enough, North Dakota doesn't specifically define engaged in business, but they, from a policy standpoint, have a few guidelines on what is a NEXUS creating activity. And a lot of these are related to physical presence. So, you know, kind of, again, akin to our sales tax nexus. If you have physical presence for, in North Dakota, you're going to have sales tax nexus and income tax nexus. So presence of agents or independent contractors, so it doesn't necessarily have to be W-2 employees. It could be a third party that's acting on your behalf. Credit checks or reports by third parties, any kind of repair services, whether that's by an employee or a third party, loan negotiations and closings. They do have a few minor rules around if you're an out-of-state, if you have an out-of-state server and you're selling cloud-based computer services, again, it's all around physical presence, but it would be in that situation if you had employees that were soliciting services in the state or hired to set up or configure those services, and then owning, leasing, or renting space on a server in North Dakota. So those all kind of seem very obvious physical presence, maybe not so much on the cloud computing. That might be a little bit of something that you might be surprised at. However, keep in mind that it's all related to the employees or independent reps that might be providing those kind of services in the state on a cloud-based computer service behalf. Now, the state currently has some guidance, and again, this is all kind of policy driven right now, where they say, okay, well, we've got a few things that we know create nexus, but then we've got a few things that we say do not create nexus. So employee training, seminars, recruiting, hiring, evaluations, local media advertising, catalogs, direct mail advertising, and then having bank accounts in the state. And then with our out-of-state servers, if for those kind of businesses, if you're granting North Dakota customers access to software on the internet, or you're selling those kind of cloud-based computer services to North Dakota customers, and you have an out-of-state server, then those activities by themselves will not create nexus. Again, keep in mind that any kind of physical presence related to those types of activities would create nexus. But what I want to call your attention to, and just like I said at the outset, just something to keep in mind is that we've got a situation where North Dakota does not, for income tax purposes, have what's called factor presence nexus. So there's a lot of states out there. We've talked about California. I sit in Denver, Colorado, and Colorado has a factor presence nexus as well for income tax purposes. And it's very similar to the economic nexus standards for sales tax. However, the thresholds in a lot of cases are higher. And so, like for Colorado and California, if you sell over $500,000 of revenue, make $500,000 of sales into Colorado or California, then those states say that you have nexus for income tax purposes. Well, North Dakota does not have a similar rule for income tax purposes, but as you recall, they do say that you would be subject to the corporate income tax if you're deriving income from North Dakota sources. So what we could tend to see in the future, and you know, this is a little bit of uncharted territory yet, but what we could see in the future is that with our states that don't have a factor presence nexus for income tax purposes, but they have a fairly broadly defined doing business standard, we could see that if we have taxpayers that exceed the nexus threshold for sales tax, that state could then argue, well, you're exceeding the threshold for income tax too because you're deriving income from our state. So that's something, like I said, it's uncharted territory. We're not sure how the states are going to react with that. However, I just want to caution people that we could start to see this, and we could also start to see nexus questionnaires come out to taxpayers, particularly as it relates to registering for sales tax. And what these states could start doing is then sending nexus questionnaires and saying, okay, well, what are you doing for income tax purposes in our state? And therefore, then we could start down this path of having to file both. Okay, so what can be a little bit more complicated from an income tax perspective and something that doesn't apply on the sales tax side is Public Law 86272. So we may have a situation where, okay, we're deriving income from a state, but let's say we're actually selling tangible goods into the state. Well, North Dakota has a pure income tax. It's a net income-based tax, and so therefore Public Law 86272 applies. And if you're not familiar with what that is, or if you need a refresher, Public Law 86272 applies to businesses that sell tangible personal property. It would apply to businesses that all they're doing in North Dakota is soliciting sales of tangible personal property, and those orders are accepted and approved and shipped from outside North Dakota. So it's a very narrow exception, but what it does is it protects that income, and then the taxpayer wouldn't have an income tax liability in North Dakota. So, like I said though, this is just on the income tax side, doesn't apply to sales taxes, and it's only for the sale of goods. And so it's very narrow, and you can't be doing other activities, or the employee or the rep cannot be doing other activities like credit checks, approving orders on the spot, providing services, et cetera, because that would kick them out of Public Law 86272 protection. So even though, like I said, we may have nexus per se, where we've got a physical presence or we're deriving income from the state, the next step in the process is, well, what am I selling, and do I have a liability based upon what I'm doing in the state and what I'm selling? And it's honestly a very similar analysis on the sales tax side as well, if you think about it, because we might be exceeding those economic thresholds. However, is what we're selling actually taxable from a sales tax perspective? So it's a similar analysis on the income tax side too. Okay, so now our next polling question. Do you have employees or agents traveling into North Dakota providing services? Yes, no, I don't know, but I better check based upon some of the information I'm hearing on this webinar. Okay, we've got some that do, a lot that don't, and actually not that many that don't know, so that's great. People are on top of their activities in the state. That's great. Okay, moving on. Okay, so I'm going to talk at first about the corporate tax regime, and then I'll talk a little bit about pass-throughs. But here on the corporate tax side, when you have an affiliated group of corporations, North Dakota is a default worldwide unitary filing. And what is unitary? And unitary is kind of a lofty term and means a lot of different things depending upon the state. There's a lot of case law around what constitutes a unitary business. But suffice it to say that technically it is a group of corporations, and they don't have to meet the definition of an affiliate for federal income tax purposes. The rules around ownership percentages and just intercompany activities and just activities in general of the entities that are related all go into what is a unitary business. And it's not just one particular factor. There's a lot of cases, like I said, out there, not just in North Dakota, but in other states that have unitary rules that have set some precedents around, okay, a unitary business typically falls into, or entities that fall into a unitary business generally have similar characteristics around unities of ownership, unities of operation, and unities of use. And these are the prongs that North Dakota uses. Now, another state could use some of these prongs and a few other tests, economies of scale, et cetera. Some of those words that you've probably heard, phrases you've probably heard around a unitary business. But generally speaking, if you have a group of corporations, and again, doesn't have to be an affiliate per se as defined under the IRC, but if it's more than 50% owned and it's in a similar line of business, or it's steps in a vertical process, if they're centrally managed, if they have similar board of directors, if they have financing decisions that are approved by the parent, for example. There's a lot of interplay amongst the entities, so much so that they really cannot operate autonomously, or they don't operate autonomously. And this is again a very subjective test versus it's qualitative, not quantitative. So it's not necessarily a black and white answer depending upon your taxpayer situation. However, they do have some guidelines here around, you know, like I said, in same general line of business, vertically integrated, or centrally managed. So those are some of the bigger tests for North Dakota. Now, like I said, it's a default worldwide unitary filing. So that would mean that if you have a group of corporations that operate in, or perhaps you have foreign subs, or perhaps you're owned by a foreign parent, then from a default perspective and you're unitary, then you would file one big group in North Dakota and then apportion your income to the state based upon the worldwide income. However, North Dakota does provide a water's edge election. There are some stipulations around that. It can be made on an original timely filed return, including extensions, so that's kind of nice. It's not one that has a separate election that's filed separate. Montana is one that has that. So you can file it with the return. However, it is binding for 5 years, so you're in a situation where, you know, if you're looking at doing this, you might want to run some numbers, because it can become a math exercise. Perhaps it's in your best interest to file on a worldwide basis because you've got all these losses, and once you make that water's edge election, you're not able to apply worldwide losses to a water's edge year, or vice versa. So sometimes you have to have a little bit of a crystal ball to know, okay, well, if I make this election, it's binding for 5 years, and then I am stuck with it. So it can be something that I would recommend that taxpayers take a look at. Members of a water's edge filing will include U.S. incorporated affiliates, excluding 80/20s, IC DIScs and FIScs, export trade companies, and any non-U.S. incorporated entity if an affiliated corporation owns over 50% of its voting stock and if more than 20% of its property and payroll is in the U.S. Okay. So from a federal conformity standpoint, the starting point for the corporate income tax return in North Dakota is line 30 of the 1120. There is a graduated rate scale. You've got 1.41% on taxable income up to 25 grand, and then up to 4.31% on taxable income above 50. Keep in mind that if you do make that water's edge election, that you have to pay a 3.5% surtax on the taxable income that's calculated on a water's edge basis. So just keep that in mind. Again, if you're in a situation where you're not quite sure if you're going to make that election, because you'll want to do the math to incorporate that additional 3.5% surcharge. Okay, and that takes us to our next polling question. What is the current maximum corporate income tax rate for water's edge filers in North Dakota? Is it 0, 3.5%, 7.81%, or 9.99%? All right. That's a little bit of a trick question. So the surcharge is 3.5%, but the total rate is 7.81%. So we kind of got half and half there. So, okay. Moving along. Maybe. Okay. All right. So I'm going to talk a little bit about apportionment for the income tax. So generally speaking, up until 16, taxpayers were required to use an equally weighted three-factor formula. Then there became an election that was available where a single sales factor was kind of being phased in. So for 16 and 17, taxpayers that made this election for the more heavily weighted sales factor, they had a double weighted sales factor for 16 and 17, so that meant you had double weighted sales and your denominator was 4. Now again, this is only for corps. Past entities are not entitled to this. So similar to the Water's Edge election, we've got a binding election for this, and it's the same time period, so it's 5 consecutive tax years. Now for 2018, under the election, so again, it has to be under this more heavily weighted sales factor election, then the apportionment factor is going to be property factor plus payroll factor plus 6 times the sales factor, and your divisor is 8. And then after 18, it's fully phased into a single sales factor. But again, only under the election. Anybody who does not make the election is under the equally weighted three-factor formula. And I don't spend a lot of time on property and payroll per se when it comes to the apportionment factor, just because those are they're more straightforward. Where we see some opportunities or more complexity is in the sales factor. However, North Dakota is fairly straightforward. Sales of tangible personal property is based on destination. So if it is a sale to a North Dakota customer and it's shipped to North Dakota customer, then that is a North Dakota sale for purposes of the sales factor. However, there is a throwback rule. So if you are shipping from North Dakota and you do not have, or you're not taxable in the jurisdiction of the customer, then that sale may have to come back to North Dakota. So what does that mean? So basically that means North Dakota's rule is fairly consistent with the AUDIT rule on this, which means that if you have a sale that originates from North Dakota and it's to the U.S. government, then it's going to come back to North Dakota because generally speaking, the U.S. government, nobody knows really where that is, right? And so that's really the theory around that. So that's going to go back to origination. Secondly, if you have a sale to a jurisdiction in which you do not have NEXUS, or you're not filing a return, then that sale would come back. So for example, if you've got a situation where you're selling to, let's say you've got a North Dakota company who's selling to Colorado, and that North Dakota company does not have NEXUS in Colorado, does not file a Colorado return, then that sale to Colorado would get thrown back to North Dakota. Similarly, if you had a situation where you had a sale to Wyoming, but let's say you had NEXUS in Wyoming, but Wyoming doesn't have an income tax. Well, that doesn't matter. Then that sale would actually not get thrown back to North Dakota because the company has NEXUS in Wyoming, and therefore it would be considered a Wyoming sale. So that's kind of how the throwback rule can work. And North Dakota is, like I said, a more, it follows the AUDIT rule, which is fairly traditional with respect to the throwback. On the sales of other than tangible personal property and services, this is where we get a little bit of gray area, and we've talked about other states where they're moving towards market-based sourcing. So usually that equates to if the benefit of the service is received in a state, then that sale of the service would go to that state. North Dakota has not passed legislation or adopted those rules yet, so they still operate under the cost performance rules, which means that if the greater cost performing the service occurs in North Dakota, then North Dakota would want 100% of the sale. So you have a situation where, and this happens in lots of states, and I know that there's a lot of talk out there about this being completely unfair, and I get it, but when we're talking about state taxes, sometimes fairness is goes out the window a little bit. But what can happen and when you have the sale of services is that, let's say, for example, Colorado, where I sit, Colorado is a partial or a proportional cost performance state, which basically means, at least as of right now, 2019, we're going to change. However, right now, let's say that a taxpayer performs some of the service for a customer in Colorado. Then Colorado would say, well, we want that piece of time that the taxpayer was there performing that service. Well, what if the majority, greater than 50% of the cost performing the service for that customer in entirety occurred in North Dakota? Well, that would mean that then North Dakota would want 100% of it, and then Colorado would still want their piece for the time that was spent here. So that's where you can get whipsawed, and we see taxpayers where that occurs, and it remains to be seen. Perhaps North Dakota will change to market-based sourcing, but I think as you may imagine, and what we're seeing right now is that we've got so many states, including North Dakota, that are so focused on the economic nexus rules for sales tax that we may not see so much movement on the income tax side. And also in that vein, some of you out there might be wondering about tax reform. You know, we've got all these federal tax reform provisions, and what might North Dakota be doing on that? Well, their legislature did not meet to discuss those provisions, and so we're in a situation where whatever they conform to as of last year, they are conforming to still, and so I believe their time frame to meet is next year, and so we might see situations where they address 965, they address GILTI, they address some of these other provisions that are part of federal tax reform, but for right now, everything is status quo. Okay, so I'm going to talk for a couple minutes about pass-through entities. And North Dakota is fairly straightforward as it relates to pass-through entities. The entities themselves, so partnerships, S-corps, are not subject to tax in North Dakota at the entity level. The income that is sourced to North Dakota that those entities distribute, so the income that is generated in North Dakota from those entities is distributed out to the partners and shareholders, and they are the ones that are subject to individual income tax in North Dakota. S-corps file a Form 60, partnerships file Form 58. They do impose non-resident withholding, so a lot of states have non-resident withholding because they want to get their money. What happens and what's happened over time and why states have instituted non-resident withholding is that a long time ago, they were just getting partnership or S-corp returns from the entities, and sometimes the partners themselves were not filing. So in order to protect themselves, the state started instituting non-resident withholding so that they would get the money, and basically what that means is that the entities pay this non-resident withholding on behalf of the partners and shareholders. And in North Dakota's case, if you've got a entity that has a taxpayer that has North Dakota distributed income of $1,000 or more, then non-resident withholding is required. They do allow composite returns for pass-through entities, and you only have to have one member. So there's situations where we have, wholly owned S-corps, and those entities can file composite returns on behalf of their shareholders. You do not have to have more than two or more taxpayer shareholders to be able to file a composite. And then, as I mentioned earlier, when we were talking about the single factor or single sales factor election, or the more heavily weighted sales factor election, that was only attributable to the corporate tax regime. For pass-through entities, the apportionment factor is still evenly weighted, 3-factor. Okay. So now that takes us to our next polling question. North Dakota imposes which taxes on pass-through entities? A minimum tax, an annual filing fee, all of the above, or none of the above. All right, actually, it's none of the above. All right, and then I believe our next slide is our last polling question, which is really just kind of more for the audience to tell us which kind of presentations you would like to see from us in the future. Would you like more information about the economic nexus implications for sales tax collecting and remitting, state income tax implications of federal tax reform, or surviving a state sales and use tax audit? And as David said, we do have our Wayfair presentation coming up on August 10th, so we really encourage everybody to register, and if your schedules permit, register and participate in that. It's definitely a changing landscape for the sales tax collection, and we've got a lot of states that are coming on board with various enactments, and we've got enforcement dates that are, kind of all over the board right now, and we're going to provide you all of that information on that webinar. Okay, so we've got our results here. So, we're kind of split all evenly here, which is great. So that gives us really good information for us. I can tell you, since I tend to focus a lot on the state income tax side here at iBailey, that from a federal tax reform standpoint, and some of you are probably well aware of this, but the states are slow to give us any guidance. And we've got some states out there that have perhaps given us some guidance on some provisions. So, for example, I've seen some states provide guidance on 965, for example, but then we don't really know about anything else. We've got some states out there that, if they're, for example, if they're an AGI state, so for individual income tax purposes, if they start with AGI, then they've probably provided some, and I say probably, and some have at this point, provided some guidance with respect to what are we doing about the standard deduction. So we've seen some movement on that as well, but I will say that the states are slow, and that information is trickling in. We've got legislatures we've only got a few states where legislatures meet continually. Everybody else's legislature has adjourned, and so we're in a situation where we're probably going to see more information later this year, earlier next year, and we'll obviously provide information as it becomes available. But with that, we're actually done with our presentation a little early, and so we're happy to open this up to questions that anybody has. So Tara, I think that means I pass it back to you.